Some things are changing quite a bit. Some things haven't changed. So some of the fundamental forces are the same. Now, superficially, we've had a lot of news. We've had Brexit. We've had the unexpected rise of Donald Trump. We've had a Turkish coup, and we've seen Venezuela implode. So there have been a lot of very important, very significant political and geopolitical developments can impact gold or commodities one way or the other. But certain things haven't changed. And I think these are important to focus on because they really drive the price of all commodities. The number one thing is the struggle between deflation and inflation. And this is something actually I talked about in my first book, The Currency Wars in 2011. I made the point because people look at the time series of price indices and we haven't had a lot of either. They've been pretty steady at a pretty low level, around 1.5%, sometimes a little hotter, sometimes a little cooler, at least in dollars. Now, actually, some of the other economies around the world, you're actually seeing deflation in Japan and Europe and elsewhere. But that is because the world is in a naturally deflationary state. The world wants to deflate. Why is that? Demographics. You not just have a slowdown in growth. Globally, you do. But in certain countries, you actually have declining populations. The population in Japan is declining. The population of Russia is declining. The population of China has leveled off and may start to decline. The only reason the US doesn't have negative population growth is because of immigration. The actual birth rate of Americans, ex-immigration, is sort of flatlining. But we do have some population growth because of immigration, but that just means it's coming from somewhere else. And then debt and deleveraging. Talk about helicopter money. We'll just give people money and they'll go spend it. Well, they might not spend it. There are two other things you can do with it. You can save it or you can pay down debt. So just handing out money on street corners doesn't necessarily get you the velocity or the turnover of money or the spending or the GDP that you want. Because people might actually, as I say, put it in the bank or pay on debt. And that is going on. So that's debt to leveraging. The third one, of course, is technology, which is a good thing. People say there's bad deflation caused by bad policy, but there's something called good deflation. Maybe we should have another word for it. But when your standard of living goes up, not because you're making more money, but because your cost of living goes down for the same amount of money, you can have a better lifestyle because things are less expensive. And that was predominant in the United States. For example, in the late 19th century, when it was an age of invention, you had the McCormick harvester, the expansion of the railroads, the telegraph, the telephone, the phonograph, and movies. All those things came in the late 19th century, maybe very early 20th century, all of which lowered costs and made people richer without more money, just meant they could do more things were less expensive. So debt to leveraging, debt to leveraging, demographics and technology are causing. I call that the natural state of the world. However, central banks cannot have deflation. They cannot allow it. And I have this debate with our friend Harry Denton and Gary Schilling and others, because they do the deflation analysis I just went through, and I agree with them on that. I think that analysis is correct, but there's a countervailing force, which is central bank policy. Governments cannot have deflation because it increases the real value of the debt. I mean, governments are over-indebted as it is. Japanese debt to GDP ratio is over 250%. Corporate debt, actually corporate, individual, and government debt in China to GDP ratio is over 300%. I mean, these are huge numbers. People pick on Greece, but the rest of the world looks a lot like Greece or is getting there fast. So deflation increases the real value of debt. So if you're over-indebted to begin with, the last thing you want is deflation. There are other reasons why governments don't want deflation, but they're determined to stop it. So you've got these two tectonic plates. There's the natural tectonic plate of deflation, but there's the policy plate of inflation, which is money printing, currency wars, QE operation, twist, all the central bank toolkit, negative interest rates, zero interest rates. They're pushing against each other. So it kind of looks stable from the outside, but it's dynamically unstable, going to snap. The question is, which way would it go? Central banks could throw up their hands and it could go deeply into deflation, or central banks could pull a few more rabbits out of a hat and it could go into inflation. That kind of monetary instability is part of the case for gold, kind of part of the new case for gold, as I call my book. But the point being, that hasn't changed. This has been going on for 5 years, and except that the forces keep getting stronger. The forces of debt deflation, negative interest rates, deleveraging get stronger. The forces of money printing and policy. And I think we'll soon see world money in the form of special drawing rights, or SDOs. So these forces are not only coming together, they're getting more powerful. And they're going to snap when no one knows. But you can say that it certainly will happen. The effect will be dramatic. When it does happen, I definitely want to own gold, at least for part of my portfolio. But I do have the sense that we're getting closer to some very significant break in the system.